Hi, this is a Pro Sam. Welcome to this episode of the Working Abroad show. When we're looking at the budget coming up, we're looking at what the tax creep will be. One of the most complicated tax creeps in the UK tax system is when you're earning between 100 and 125,000, because the tax rate goes from 40 to 45,000, but it's a gradual, complex situation. And it's not a very satisfactory one. And this is a perfect opportunity for a tax raising government to, uh, first of all, claim in their budget that they're simplifying the tax regime, while at the same time meaning that you're going to pay net more tax. Technically, marginally, between 100 and 125,000, you could be paying up to 60% tax. Labour governments of the past have had taxes right up to 98%. They won't go that far, but they can make changes which will have a net result, which will be negative. And this is one of the big ones for high income earners. But it's not just income that's under threat, it's your capital assets. Now, what are your capital assets? The shares and investments that you own, the valuable items like paintings or jewellery that you might own. Most importantly, they're the property that you own. So property, uh, uh, owners of property are potentially under attack in the budget with more tax creep. A succession of changes have appeared over the last 25 years. It's very, very easy for them to claim simplification of the current situation, uh, leaving a net tax rise that's going to happen. For more information and guidance, contact us at projectpartnership.com, and we're going to give you a free review and advice on what you might do. We can look, for example, at council taxes. Council taxes have gone up um, regularly by inflation, but anybody now who owns two properties and one of them is left vacant, the local council at its discretion can charge up to twice the council tax rate. So that is a fixed income. Now, if you're an expat living and working abroad, or if you're buying a property overseas and you're spending a lot of time there, it gives a scope for the tax office to say it's not your main property. We're going to charge you extra council tax on that. But then it gets even more insidious. What about the personal residence relief? Now, the personal residence relief is if it's your own and main home in the UK, you get capital gains tax relief when you sell. Now, in the last budget, in the Halloween budget of 24, um, they increased capital gains tax by 80% from 10 to 18%. So there's two rates of capital gains tax now, 18 and 24%. Now, if you sell a residential property that's your principal private residence at the moment, it's capital gains tax free. But if it's not, you're paying 18 or 24% capital gains tax. Now, that could be simplified quite easily. Um, and in a number of ways. For example, they could align capital gains tax to income tax rates to make it 20 and 40%. Let's simplify the tax rate. Or they could change the definition of principal private residence. Look at it at the moment. If you sell your property and you move in the UK or abroad, then technically you've got up to 9 months to sell it and still get that principal private residence relief. Something's up to the HMRC's discretion. But if you've got two homes, why not simplify the rules if you're a tax creep government? Why not simplify the rules by saying if you've got two properties that you own personally, one cannot be your main residence unless you're living in it. What if they decide that you have to not only live in that property, but also be a tax resident in the UK to get principal private residence relief? If that was the case, any expat, any UK expat or anybody buying property in the UK as their second home, their principal private residence in the UK, would then suffer capital gains tax when they sold that property. So if you own a property in Spain or Cyprus or Portugal or France, um, your second home will suffer, your overseas property will suffer a capital gains tax when you sell it. Why not the UK do that for everybody? But tighten the rules, simplify it. If you're a tax resident in the UK and you own property, uh, if you're not living in it and you're not a tax resident in the UK, you can't get principal private residence relief. It's a big threat for expats living and working abroad. Bearing in mind, capital gains tax only applies when you sell the property. So it's not something that's going to impact now. So you can't, it's not something to force sell, but of course it will make property investment in the UK less attractive. And then you'll see prices going down and stagnating. Capital gains and residential property income in the UK is fixed in the UK. You can't change that. So that is just the way it is, okay? So you're always going to get tax on that. But another way that it could dramatically change for us in the budget is that they say that let's put up income tax from 20 to 22%. But for working people, let's reduce national insurance down by 2% so that working people don't pay any more tax. Well, that's first of all confirmation of the tax creep that national insurance is taxed by another name. It does contribute towards benefits and child benefits and welfare benefits and state pensions, so it can be a good thing. But why not do that? Reduce the national insurance for working people and increase the income tax for everybody else. Now, what would that do? It would mean that the definition of the government in the UK of working people is people earning under £45,000 a UK taxpayer. So anybody who's not doing that as a working person in the UK would get an increase in their tax without the alongside reduction of national insurance. So if you're working remotely and paying tax in the UK from your investments or an asset that you've got, then that will mean a net increase in your tax. So a 20,000 a year property rental portfolio could see income tax go up from 20 to 22%. So instead of paying 4,000, you're paying 4,400, just like that. Whereas a working person on 20,000 would pay the same net tax because national insurance will be reduced. Another big property tax is stamp duty. If you want to discuss any issues on these taxes I'm raising, do contact us at piratepartnership.com. Another tax on property, which is confusing and complicated, is stamp duty. Now, stamp duty can range from nothing right up to as much as a total of 18%, depending on what type of property that you're buying and what your circumstance is. So if it's not, they could change the rules to say if it's not your main property, if you've already got another property, you can't have any stamp duty relief. They could change the rules to say stamp duty is going to be the same rates as capital gains income taxes, 20 or 40%, or they could do something more radical and charge a wealth tax instead. So let's have a look at some of those options in a bit more. First of all, we've got the complexity of council tax, the complexity of rental income, and the complexity of CGT, and the complexity of stamp duty. Now, any of these could be argued, could be simplified. You could abolish capital gains tax and say if you make a capital gain, it's added to your income tax bill. So that could take somebody who's a 20% taxpayer making a 40,000 profit on a property sale into a higher rate taxpayer. They could simplify to take the tax bands. At the moment, we've got 18 and 24 capital gains tax, 20, 40 and 45 income tax, with 40 to 45 be really, really complicated. We could simplify that. Now, if they increase the tax don't increase the tax on working people, those earning below £45,000, They could increase income tax but reduce national insurance. But that means everybody's paying 2% more on everything. And why not simplify the 45% rate and come up with a figure 44%? So removing the 45% band, and you're replacing it with either a reduced rate at 44, or you can maybe reduce everything to 44. But it's not really the style of the government to want to reduce rates. End up with two tax rates. You could harmonise all the capital gains within that, and therefore, de facto, everybody earning more than 50,000 a year